Directors like you fail because they make the same mistakes over and over again. More limited companies than ever are closing in the UK. And it's because directors ignore HMRC. They keep trading when they shouldn't and they leave it too late to get help. Now, these mistakes can turn a tough situation into a personal disaster. And if you don't learn from them, you risk losing far more than your limited company. You could go bankrupt and end up losing your home. Now, there are 7 biggest mistakes that I see directors make every single month. So I'm going to go through them with you. Mistake 1 is ignoring HMRC. His Majesty's Revenue and Customs. They are an easy person to ignore. People think I'm crazy saying that, but I know if you don't pay your first VAT bill, you'll just get letters and you'll go, you know what, Chris, I'm going to pay it next quarter. I'm going to make up for it. And then you have a bad second quarter. And before you know it, you're 2 VAT quarters behind. Now, HMRC is chasing £44 billion in unpaid tax. They've got more than 2,400 extra staff who are there to knock on people's doors, enforcement agents. And they've invested over 600 million to chase this money that they're owed. The HMRC has got to get a return on that money and that recruitment drive. Now, I have never seen a time where there's been more enforcement agents knocking on people's doors collecting tax debts. And in addition to HMRC enforcement agents, we've seen more HMRC issued winding up petitions than ever before. And that number's rising. Now, the reason why it's a mistake burying your head when it comes to HMRC is it doesn't buy you time. It actually accelerates the enforcement you're trying to avoid. Now, I've been there where I'm thinking, oh, well, don't really want to open that brown letter envelope, really don't want to ring people, but it is a big problem. If you don't talk to them, you're just going to go through that debt collection process. And there's more people on HMRC's side now collecting the debts that you owe them than ever before. Mistake number 2 is trading while insolvent, okay? Now, if you can't pay your debts when you fall due, or your liabilities are more than your assets, it's a sign your business is insolvent. Now, I'm not saying if you fail those tests, you should shut the doors immediately, but here's the question I want you to ask yourself. Have you got any hope of recovering? Have you got any hope of getting back on a firm financial footing? And if the answer is no, you've got to be really careful about what you do tomorrow. Because once you know your company can't pay its debts and you know there's no hope of recovering, your duty is now to the creditors and not making their positions any worse. If you keep trading recklessly, you could be accused of wrongful trading. If you keep taking on deposits of jobs you're never going to take, never going to be able to fulfill, you could be accused of fraudulent trading. Listen, these are both really, really serious problems and it will open you up to personal liability. So let's say you know you're insolvent, okay? You fail every insolvency test, you've got no hope of recovery. But from that point, you rack up a load more debt with HMRC, you rack up a load more debt with suppliers. That increase in debt that you've incurred since becoming insolvent could land on your toes personally. So thinking, oh, I'm going to hold out for another month, let's see what's happened, you know, all that positive thinking in this scenario can really bite you on the backside. You've got to see things as they are, not worse than they are, not better than they are, as they are, because your decisions have consequences down the line. Listen, mistake number 3, the bounce back loan saga, misusing bounce back loans. There are billions that have been flagged for fraud, okay? There's a new bill called the Fraud and Recovery Bill and it's given the government extra powers and extra years to chase these issues. So if you inflated your turnover and you took a bounce back loan, okay? Or if you took a bounce back loan and you weren't meant to take a bounce back loan, you wasn't entitled to one, or you've took 2. If you go through an insolvency, that's going to cause you a problem. There will be personal liability landing on your doorstep, and in the most severe cases, there's going to be prison time. So the mistake I see people make is assuming that the government are going to guarantee it and it protects you. Listen, the government have guaranteed the bounce back loans, and if the bank haven't got the money off yours and you've defaulted for over 3 months, and you've not made a payment in 12 months, the chances are the government have already been paid back the bounce back loan. But if you've done something with it and then you go into insolvency, that is going to open a whole can of worms for you personally. Mistake number 4 is overdrawn directors' loan accounts. Listen, most people don't even know what these are. So I'm going to give you the idiot's guide, and I say idiot's guide so I can understand it, right? An overdrawn loan account. Let's talk about what a director's loan is. It is a ledger, okay? When you put money into the company, perhaps at the start of the business, it goes as a credit on the director's loan. When you take money out of the company, it goes as a debit on the director's loan account. Now, where people get stuck is, we're all told to take a combination of salary, say £1,000 a month, and top up our wages as dividends. Now, what you don't get told is, A, dividends are only declared at the end of the year when you do your accounts. So let's say you take £1,000 a month as salary and you're taking £3,000 a month in your head as dividends. It's not a dividend. You're taking £3,000 a month as a drawing in anticipation of a dividend down the line. Now here's the problem. If you're insolvent, your company has got no profits to declare a dividend. Therefore, all that money that you're taking that's not salary is going to be converted to an illegal dividend, and it will go on your director's loan account. And most directors don't understand that. And here's the big problem. In insolvency, the insolvency practitioner is going to chase that director's loan account aggressively. Now, I've seen DLAs, £5,000, £10,000, £15,000, £100,000, £1 million, okay? The reason why it's a mistake, if you treat company money like personal cash, it can cause you a serious problem down the line. If you don't go through an insolvency, you're going to be whacked with S455 tax, which I think is about 33.75% that you have to pay on top of your corporation tax if you don't pay the loan back inside 9 months of your year end. But if you go through an insolvency process, and let's say you've got a house with lots of equity in, that insolvency practitioner is going to be coming knocking for that money that you owe the company. Mistake number 5, preference payments. Okay, so once you become insolvent, you have got to be really careful who you pay. And you have got to treat all creditors equally. So if you're paying friends and family, or one supplier ahead of another, or paying off your personally guaranteed debts, an insolvency practitioner could have an issue with this. And what they could do is they could go for the person that you've paid the money to, but what's more likely is they'll actually, it's called setting it aside, and they make you personally liable for the payments. It's essentially you are favouring some creditors over others, and insolvency practitioners don't like it. You're not allowed to do it. So I understand people are trying to protect key relationships, but there is a fine line between protecting key relationships and treating creditors unfairly. It's a mistake. Be careful. Okay. Mistake number 6, mixing business and personal finances. Okay. So let's say you're using credit cards for business expenses, but you're not billing it back to the company, or you're moving cash between personal and business accounts with no paperwork, or the other way around. What it does, it creates suspicion, and if you've taken out more than you've put in, you've got an overdrawn loan account, and you'll be personally liable for that. And the reason why it's a big mistake is when you're blurring the lines, it's one of the things that destroys the protection of limited liability. So everything you're doing, make sure there is a paper trail. And mistake number 7 is waiting too long to get advice. So in 2025, over 25% of insolvencies are compulsory liquidations. That means the directors known they were insolvent, they could have gone down to the voluntary route, but they've waited until a creditor has forced it upon them, okay? Now, once you get a winding up petition on your doorstep and you get your day in court, if you do not pay what is due, you are wound up. Your voluntary options like a liquidation or a CVA or an administration are gone. And why it's a mistake? It's because every week you wait, options close. Delay equals a loss of control. Now, for you guys out there, you want to try and limit the damage for you personally. Most of yous do. Waiting to be wound up is the worst thing to happen. The consequences will almost almost always be more severe. And the first thing you're going to be accused of is, well, you've not behaved correctly as a director. Because I said earlier in the video, when you become insolvent, you've got to take steps to ensure creditors' positions aren't made any worse. If you've waited for a creditor to wind you up, the first thing they're going to say is, well, maybe you're unfit to be a director. You could be disqualified. So why do people keep making these mistakes? I have pondered on this for years, and I've drawn a list of the reasons why I think people are making the mistakes. And why I'm really well qualified to tell you this is because I've been in that position. And I remember feeling a lot of shame. You know, there's a big stigma to insolvency, and there shouldn't be. I saw liquidation as personal failure. And there's a lot of advice out there that I never understood. There's a lot of people in my profession that will sit down with you, and instead of talking to you like this, they're going to spout the Insolvency Act at you, and they're going to make you feel like a naughty schoolboy or a criminal. That's how I was made to feel. It was awful. You know, I had the weight of the world on me, and in addition to that, I had people telling me all sorts of stuff that actually didn't end up happening. I think it was designed to scare me. So I don't think your accountant's always best advice either. They don't really explain the risks. I also think there's a lot of false hope with directors. Like, we're taught to think positively. Honestly, I've read all the positive thinking books. You know, the next month it will be better, while actually your bills are piling up. And again, I always say to people, right, you've got to look at things as they are, not worse than they are, not better than they are. You've got to look at the facts. And looking at the facts will determine on what your options are, okay? Now, what's the result here? Good directors making bad decisions that cost them everything. Like, good people make these mistakes and they really pay for it. So how do you avoid the mistakes? I've said it a few times already. Step one, face reality early. If you can't pay debts, you're insolvent. And if you don't have any way of recovering, you've got to accept that actually I perhaps need to use an insolvency option. And the way that you make those decisions is have a look at accurate information, okay? And it starts to lead on step two, keep clean records. Listen, your conduct's going to be questioned. If you're going to an insolvency practitioner with an up-to-date balance sheet, a profit and loss, a list of aged creditors, it shows that you're organised. Step three, know your exposure. Know what's going to bite you on the arse down the line. Check your personal guarantees. Check where your director's loan account sits, okay? This is how I'm going to talk to you about doing this. PGs, speak to the bank, speak to the credit card companies, ask the suppliers. Do this before you appoint the insolvency practitioner. Whether it's a director's loan account, have a look on your, and please tell me that you've got management information. Tell me you're using Xero, QuickBooks, Free Agent, something like that. Because if you do, and it's up to date, it's dead easy. You go on trial balance and it will say in the assets section or the debtors section or the director's current account section whether you have a director's loan account. Now, if you don't have any of that information, do you know what? If anything I've said has sparked something, click the link downstairs. Click the link in the description box and one of my team will call you today, okay? And we'll help you understand your position on the director's loan and potential ways of dealing with it once you're in insolvency. Listen, step four, get advice before creditors act. Voluntary processes will put you in control. A compulsory takes it all away. Now, I know how you feel because I've been there. I understand how UK directors mess up. I know about ignoring HMRC. I know the risks of trading while insolvent. I've spoken to hundreds of people who've misused bounce back loans. The best option for them guys is, girls, pay it back. I can warn you about making preference payments. I can help you understand your director's loan positions. But waiting too long is going to diminish the options you've got. Most directors don't fail because of their business, they fail because of these mistakes. So if you are a UK director under pressure, don't repeat them. Contact us at Director First today. We will protect you as much as we can. We will advise you on what your options are. We will advise you on where the pitfalls are. Now, if you've enjoyed this video, I want you to go and watch that video there, right? That video there is going to tell you everything that you need to do before you appoint an insolvency practitioner. We're going to talk about selling assets. We're going to talk about overdrawn directors' loan accounts. There's going to be a checklist. It is a must-watch video. Go and watch it now. Thanks.